Look, I think Federal Reserve is pretty much done. They already ignored inflationary targeting. Whatever the new framework is unlikely to make any difference. They're going to be incredibly dovish. At the same time, remember, they essentially threw away Phillips' curve. So they're no longer worried about wages. They're no longer worried about inflation. What they continue to worry is volatility in spreads. And right now, both are looking pretty good. So I think Federal Reserve will continue to be dovish as we go forward. I think the key over the next several months is really presidential elections in the United States, an extent to which it does impact Asia Pacific.
Can this broader market rally then across the Asia Pacific then continue if we're going to be watching US politics?
Well, it can. You cannot predict what you can't predict. And clearly politics and geopolitics is one of those issues that's beyond the realms of trying to estimate probabilities. But what you can argue is that central banks globally continue to pump a lot of liquidity. Really hasn't been a great deal of slowdown at this stage. And secondly, fiscal stimuli also continues to go through the system. Remember, in the last 3 or 4 months, we effectively put in between 20 and 22 trillion US dollars. That's like inventing US economy out of nothing. So your real concern is if suddenly we believe recovery is not going to start in any meaningful way in earlier 2021. And at that point in time, a lot more stimuli really will be needed.
What about when it comes to tech? Are you a cautious investor when it comes to the tech front, or indeed still bullish on the sector, which has, of course, seen a correction of late?
Well, I'm not so much in tech, but anything that has a significant circular story behind them, I continue to be bullish. Is what I prefer to call quality, sustainable growth thematics. A lot of it is tech, but some of it isn't. And so to my mind, if risk-free rates are close to zero, if central banks control equity risk premiums, which is what they're doing now, any company capable of growing in that climate could become almost infinitely expensive. So I continue to support quality growth thematics rather than suggesting a very significant rotation in value. I think we are going to have some rotation in value, but only when we become a little bit more confident what is going to happen in earlier 2021.
How closely are you watching US-China tensions, trade talks there, and especially everything that's going on with TikTok, which we've been reporting throughout the course of the day?
I do, like everybody else, but on the other hand, I don't really. I think separation between the United States and a broader Western China is something permanent. I don't think change in leadership in the United States or in any other country actually will make a significant difference. So the question is not so much whether it's going to get much better, but the question is how do we manage that separation over the next 2, 3, 4, 5 years? So I do watch it, but on the other hand, certainly over the last couple of years, I've accepted that the separation, particularly between Anglosphere and Sinosphere, is permanent.
Very quickly, do you like China markets then with all of that in mind?
I do. In a sense, if you're an emerging market investor and you're relying purely on the cheap labor, cheap commodities, and global reflation, you really are not going to see a hell of a lot. Really, those countries won't be able to move forward. So the only thing we do need is very large domestic scale, which is what China has. Secondly, ability to pursue aggressive fiscal and MMT policies, which what China has. And thirdly, we need intangible capital. And China has more intangible capital than the rest of the emerging market universe combined. So I'm still positive on China despite all of those issues.